Welcome to Growth Investing Mastery. Today's video is called Investing in the Zone. As a reminder, this is not investment advice or recommendations to buy any stocks. The material in this video is adapted from the book Trading in the Zone by Mark Douglas, which I recently reread. The subtitle is Master the Market with Confidence, Discipline, and a Winning Attitude. We will focus on details that are relevant to investing rather than trading. I got some feedback from a close friend and subscriber to the channel that on previous psychology videos, they felt I was mixing up investing and trading a bit. So in this video, I'll focus only on things that are relevant to investing. Mark Douglas coached traders for 18 years, and he saw the same patterns and issues come up time and time again. In this video, we'll first look at successful traits for investors, and then strategies and mistakes to avoid for investors. The big concepts or takeaways I found from this book are to invest without fear, to think in probabilities, to appreciate the uniqueness of every situation the market can offer, and lastly, the market offers unlimited freedom of expression. First, we'll look at some traits of successful investors. Mark Douglas says the determining factor is psychology. The consistent winners think differently than everyone else, and winners have attained a mindset that allows them to remain disciplined, focused, and confident in spite of adverse conditions. Successful investors have confidence in their own investments, and they trust themselves to do what needs to be done without any hesitation. They no longer fear the erratic behavior of the market. These investors are able to spot opportunities to make a profit rather than information which reinforces their fears. They trust their edge in the market, and they've broken through what Mark Douglas calls the threshold of consistency. After achieving consistency, investing will become easy, simple, and stress-free. And that same investor can experience investing the way a person with no position watches the market. Lastly, the successful investor can enter or exit investments without the slightest emotional discomfort. Let's talk about some successful beliefs the superior investor has. They learn to believe you don't need to know what's going to happen next to make money, and anything can happen. Every moment is unique, and these 3 points are related to each other. Becoming a successful investor is something you have to grow into, and growth implies expansion. We need to train or override our natural way of thinking, which can be counterproductive. The market is like a stream or a river. It's in constant motion, and it doesn't start or wait for us. We need a carefree, objective state of mind, perceiving what Mark Douglas calls the now moment, where nothing is blocked. Make yourself available, Mark Douglas says, with nothing to prove, where we aren't trying to win or lose. The best investors are trained to believe in the uniqueness of each moment. They accept the risk of investing and eliminate ways to define the market in painful ways. Consistent results are a function of eliminating errors, and self-discipline equals a mental technique to redirect attention to our goal. Now we'll talk about the path to success. The threshold of consistency is usually preceded by a great deal of pain before acquiring the kind of attitude that allows us to function properly. Most of us are not fortunate to receive proper guidance or be born in a successful investing family. And hopefully this YouTube channel can help you avoid some investing mistakes. We need to adjust our attitudes and beliefs so that we can invest without the slightest bit of fear. And no matter the outcome, we are responsible for our results. We need to act on our own ideas, put our creative abilities on the line, and get feedback from the market. Additionally, we need to learn to control ourselves and structure our mental environment so we behave in a manner that is consistent with our own best interest. Our ultimate goal is consistency, as Mark Douglas points out. We need to invest without fear, and successful investors have virtually eliminated effects of fear. And Mark Douglas put virtually in quotes, because it's impossible to be perfect all the time. And I'll have an example later where I became susceptible to fear. We need internal discipline to counter the negative effects of euphoria and overconfidence, which are on the opposite side of fear. Overthinking removes you from the zone. And Mark Douglas points out, a pro athlete acts instinctively. They don't need to think through every movement. Let's continue discussing traits of a successful investor. We need to completely accept responsibility for the outcome of any investment we make. A winning attitude is equal to an inherently creative perspective, and taking responsibility is equal to the cornerstone of a winning attitude. The solutions are in your mind and not in the market. We want to take advantage of what the market is offering at any given moment. Consistent behavior means we are no longer susceptible to blocking or obscuring. Accepting risk is accepting the consequences of our investments without fear or discomfort. Our state of mind is not affected by the market's behavior. And Mark Douglas says the objective of the book is to teach you how to take the threat of pain out of the market. We need to be able to perceive the opportunity available, not the threat of pain. Every successful investor has trained the mind to stay properly focused in the now opportunity moment. We need to start thinking in probabilities, and the investing belief that anything can happen trains us to think in probabilities. We want to think like a casino owner. The casino knows every blackjack hand has an edge. For every dollar wagered, the casino wins approximately 3 cents. Yet there's massive unpredictability at the micro level, as anything can happen on one given hand. But there's certainty at the macro level. If there's enough sample size, the casino will win in the long run. And it's the uniqueness of each hand which makes it unpredictable. If our edge is good enough and our sample size large enough, we'll become a guaranteed winner in the long run. And we stop trying to predict outcomes. When you truly believe you don't need to know, you will be thinking in probabilities. And Mark Douglas says, you will have no reason to block, discount, distort, deny, or attack anything the market is offering. We train our mind to appreciate the uniqueness of every moment, and we must deactivate beliefs to the contrary. Accepting the risks means we are at peace with any outcome. Let's discuss what it means to invest with an open mind. Firstly, if we're going to feel great when the market does what we expect, and feel horrible if it doesn't, then we are not neutral or open-minded. We want to be rigid in our rules and flexible in our expectations. Yet most investors are the opposite. They don't want to make rules, and they have set expectations about how things should go. We have to neutralize our expectations about what the market will or will not do in any given moment or situation. Setting appropriate expectations eliminates the potential to define and interpret the market as painful or threatening. When we hold on to the notion that we know what happens next, that stops us from taking unknown variables into consideration. We need to approach investing from the perspective where we don't know what happens next. When you believe in the uniqueness of every investment opportunity, there's nothing for the mind to try and associate to. A unique outcome is not something we can already know. Let's talk about the secrets to investing. The first is to trade without fear or overconfidence and to be balanced. The second is to perceive what the market is offering. The third, stay focused on the now opportunity flow. And the fourth, spontaneously enter the zone. The best investors evolve the belief that anything can happen, and we need to make ourselves available to perceive information and open ourselves to find out what happens next, instead of assuming we know. Ultimate success as an investor cannot be realized until we develop an unshakable belief in uncertainty. Mark Douglas says, "The market can do virtually anything at any given time." The solution for us is to accept the fact certainty does not exist. Paradoxically, this will create certainty for us. If we achieve complete acceptance of the uncertainty of each investment, our frustration with investing will end. Now we'll get into some patterns we want to avoid in investing. And first, we'll discuss fear. There's 4 primary investing fears. Number 1 is being wrong. Number 2 is losing money. The third is missing out, sometimes called FOMO. And the fourth is leaving money on the table. By leaving money on the table, we mean the fear that we have sold a stock too soon. And there's a common perception that investors should fear the market, but that fear will act against you in a way to cause the very thing you feared to come true. Being fearful allows no other possibilities to exist, and fear is immobilizing. We freeze or run. Confidence and fear are contradictory states of minds. They cannot coexist. If we perceive the market in a fearful way, it will cut us off from the now opportunity flow, and the mind is naturally designed to block threatening information. Mark Douglas says, "The threat of pain generates fear, and fear is the source of 95% of the errors you are likely to make." Let's get into more details on fear in investing. Any degree of struggle or fear associated with investing will take us out of the moment and flow, diminishing results. And sometimes you'll hear you need to steel yourself or toughen up in investing, but Mark Douglas says, if you are not stressed, why would you need nerves of steel? Fear is a debilitating form of energy. It causes withdrawal and instincts to protect or run. Fear also narrows our focus, making it impossible to learn anything new. There becomes a tug of war with fear. We don't want to miss out, but we don't want a big loss either. The result is doing nothing and being paralyzed by conflict. It seems the market is offering threatening information, so our hesitation is justified. But pain doesn't come from the market, but how we interpret the available information. We cannot let our pain avoidance mechanisms cut us off from what the market is communicating. And pain and suffering break down our organized investment guidelines or rules. Now let's look at some common pitfalls investors may fall into. They assume more market analysis is the solution to investing difficulties or the lack of consistent results. Mark Douglas calls this the black hole of analysis. It may happen that we plan investments which never get executed and execute investments we never planned. We believe the market's behavior is causing the lack of consistency. Another pitfall is to anticipate all the ways the market can make you wrong, but the market offers too many conflicting variables to possibly anticipate them all. It feels like you can't trust the market, but really you can't trust yourself. Unlimited freedom in the market offers us potential to do enormous damage to ourselves, and nothing in society prepares us for this boundaryless environment. Mark Douglas gives the example of a baby crawling towards a glass vase, and the parents scream, "No," and the baby starts to cry because the baby doesn't understand why it can't have that glass vase. Nearly every investor resists the idea of creating strict rules for themselves, and it's easy to avoid the mental work required in favor of doing a random approach. Another pitfall is to view the market as a social activity because of how many people are involved. But the reality is, it's every person for themselves in the market. Let's continue on with some more pitfalls in investing. Any degree of blaming means you have not accepted the reality the market owes you nothing. You, not the market, are responsible for your success or failure as an investor. And often a beginning investor will get a winning trade, but then they accumulate some losses. The common reaction is to study more, but the sudden shift in mindset goes from joy to pain, and it causes a psychological shock. There's a false assumption that knowing something new will prevent more pain, and more learning ends up creating more expectations. But the investor may get debilitated and end up in a vicious cycle. Euphoria and self-sabotage have extremely negative effects on the bottom line. Euphoria equals supreme confidence, where the possibility of getting things wrong seems inconceivable, and the investor is now in deep trouble. When we're on a winning streak, we become susceptible to sizing too large or violating our own rules. And you'll often notice unsuccessful investors are obsessed with market analysis. They crave the certainty it appears to give them. Let's talk about what it looks like to invest out of the zone, or when we make mistakes. Recently, I was investing far out of the zone, without discipline, and with fear. I was making every mistake in the book. And sometimes just because we know the rules or what we're supposed to do, it doesn't always mean we can execute on it. There was a company I own called BioStem, and it was dropping significantly daily. I was holding on, waiting for their earnings report on April 2nd. The day before earnings, on April 1st, the stock dropped 10% on low volume, and after hours, they announced a filing delay. The company is listed on the Pink Sheets, or OTC, and I began to panic a bit. What if they actually delisted from the Pink Sheets? The company's explanation was the filing was delayed because they're in the final stages of uplisting to the NASDAQ. But I also realized I know very little about this process of going from the Pink Sheets and uplisting to the NASDAQ. I ignored the uniqueness of the moment, and I thought I've seen this scenario before where a company delays its filing, and it's almost always bad. I'll compare the situation to a poker hand I played, and I used to play poker professionally, and I remember this one hand specifically. My opponent had taken a really weak betting line, and I'd seen many times where if an opponent did this sequence of bets, it was almost always weak. And I decided right there, I'm just going to run a huge bluff on this guy. And I went all in on the river. And he called me with a huge hand, and I was out of the tournament. I almost never made moves like that, and I became fixated on the betting pattern was weak. But I didn't think about the scenario in full, and I completely ignored the uniqueness of the opponent and the moment. I want to talk now about the numerous mistakes I made in this scenario. I made a snap judgment on how BioStem stock would play out. I wanted to sell half my position to reduce the risk, yet I didn't write down my trade like usual, and one of my rules is to write down my trades, so I don't go into the brokerage account and just start clicking randomly. But that's exactly what I did. I went into my brokerage and sold half my shares. I began to feel some relief that I had sold them, and I decided right there, why not just sell them all? At first, I was using limit orders because the bid-ask spread on the stock was a little bit wide, and then I switched to using market orders. I was basically just random button clicking, and I knew immediately after I was tilting. I kept checking the price later in the day, and that's not usual for me. Usually after I've sold a stock, I don't really care what it does, but I kept second-guessing myself, and the signal was I was getting upset when the price was rising again. I started getting angry at myself because I was making all these beginner mistakes right in a row. After some reflection, I realized my fear of the general market had built up. As this April 1st and April 2nd day, the market was getting hammered pretty hard. And in one of my previous videos, I mentioned accumulated fear is guaranteed failure. But I got back on my feet a few days later and calmed down. I reevaluated the situation with BioStem, and I realized I really did want half a position, and if I just stuck to my original plan, there would have been no issues. So I started a position in BioStem again, but this time I followed my rules. I wrote down my trade first, and went through things carefully. I made sure to follow another one of my rules, which is to write down a sentence or two about why I'm making a new investment. After some reevaluation, I thought BioStem's explanation of the NASDAQ uplisting makes sense, and this is a very unique situation for a company to be in. I was also thinking some more about why I was making all these mistakes, and a lot of people have said the recent market is turbulent, and I think turbulence is a good analogy here. Recently, I was on a plane flight overseas, and suddenly the plane started shaking a lot. The pilot said to buckle our seatbelts. And the turbulence got worse, and all of a sudden he said, "Flight attendants, take your seat." Next, the pilot came on the microphone a few minutes later and said there was a problem with the computer entertainment systems, and he was going to restart all the computers. And you could feel the fear around the airplane. About 30 minutes later, there was a second round of turbulence. But by this time, I wasn't nearly as fearful. My mind had adjusted to the new scenario. And I think this is similar to the market, where I wasn't used to having the market drop 10% on a day and then go back 5% and drop another 10%. But now I've become accustomed to the more high variance environment, and I'm not nearly as fearful. The last point I'll make here is mistakes point the way to where we need to focus our efforts to grow and improve. And just because we know the rules doesn't mean we can always execute properly. Lastly, let's talk about some additional resources on this topic. My study corpus for mental game and investing psychology includes Trading in the Zone by Mark Douglas, The Disciplined Trader by Mark Douglas, and The Mental Game of Trading by Jared Tendler. You may notice every one of those books has trading in the title. Yet this is a channel on investing. But most of the really good psychology on investing or trading actually comes from the trading world. I'd be curious if any listeners know of some serious authors on investor psychology or resources there. And if you do know something, leave me a comment. This concludes the video, and if you enjoyed it, leave me a like below. Thank you.